In part 1, I covered Palo Alto, NVIDIA, and Arista. Now, the two that I think have the most interesting data setups in this entire group. Salesforce, down around 20% from its 52-week high. And when I pull it up on Invyra, the gap between what the market is saying and what the data says is one of the most striking things in this entire watch list. Fair value, $359.85. Current price, $209.60. 41.8% undervalued. Invyra's model says you're buying a business worth $359 for $209. That's a significant discount. IQ score, 7.6 out of 10. Buy. Let's look at what the business is actually doing. Revenue $41.52 billion, up 9.6%. Free cash flow, $14.40 billion. Gross margin, 77.7%, meaning for every dollar of revenue, Salesforce keeps 77 cents before operating costs. That's software level margin, strong pricing power, and look at that free cash flow, $14.4 billion. That's real money hitting the bank every single year. Not accounting adjustments, actual cash. Does that look like a broken business to you? It really doesn't. Opportunity dimension, 8.9 out of 10. Highest in the group. This score reflects the size of the gap between price and value. When that gap is this wide, the potential upside is significant if the business quality holds. Moat, narrow 7.0. Highest moat, score among the discounted names today. 15 years of enterprise data, workflow integrations, and customer lock-in. That doesn't unwind quickly. ROI, C 10.1% against WACC 8.1%. Value is being created, but the spread is thin. This is the one metric I'm watching to see if it improves or compresses. Prism says, hold at plus 20. That's dropped from yesterday. The 50-day MA is still below the 200-day, meaning the technical uptrend hasn't reversed. RSI at 72.6, getting overbought after today's 9.68% jump. Williams %R, strong sell signal technically. The fundamental case is strong, but Invyra says, wait for clearer alignment before acting. And today's big move actually makes the short-term timing harder, not easier. The real question on Salesforce is whether the AI disruption fear is structural or temporary repricing. The data and smart money seem to be betting it's temporary. And finally, ServiceNow, up 9.24% just today. But zoom out and you see the full story. This stock dropped nearly 40% by April, then started clawing back. Right now, it's still down about 25% for the year. And yet, when I open Invyra, the fundamental data tells a very different story from that chart. Fair value, $216.70. Current price, $135.86. Discount, 37.3%. Invyra's model says this business is worth $216. It's trading at $135. That gap doesn't appear by accident. IQ score, 6.6. Buy signal. Revenue, $13.28 billion, up 20.9%. That's solid growth for a business of this size. Free cash flow, $4.58 billion. Durability score, 8.0 out of 10. Durability measures how sticky the business model is. Customer retention, how locked in users are, how recurring the revenue is. And 8.0 is telling you, once ServiceNow is embedded inside a large enterprise's IT, HR, and operations workflows, those contracts don't get canceled. They expand. Think about it this way. If your entire company's IT help desk runs on ServiceNow, ripping it out isn't a weekend project. It's a multi-year nightmare, so customers don't leave. ROIC 11.3% against WACC 7.1%. A healthy 10-point spread, real value being created with good margin. Smart money, plus 3, basically flat neutral. No strong conviction from institutions yet. They're watching and waiting. Prism, hold at plus 18. RSI at 82.6, overbought, especially right after a 9% single-day jump. Williams %R sending a strong sell signal. The algorithm says conditions aren't clean right now, so what happened to ServiceNow earlier this year? Q1 2026, they beat revenue estimates. EPS was fine, but there was deal slippage in the Middle East. On-premise contracts got delayed, not canceled. Market read it as a pipeline problem. Stock dropped 15% in one session on solid results. That's the disconnect. Revenue growing 20.9%, durability score 8.0, trading at a 37.3% discount to fair value. The data says market overreaction, but the RSI today says the timing isn't clean right after a 9% bounce. This is exactly the kind of situation Invyra was built for. When price and fundamental value diverge, you need clear data to think through it calmly. Alright, stepping back and looking at all five together. Here's my honest read. Palo Alto, 73.5% above fair value. Opportunity score 1.0. RSI at 84.5. The business is real, but the price has run so far ahead that almost no margin of safety remains. For me, this is one to watch, not chase. NVIDIA, fairly valued by Invyra's model. Wide moat 8.4. ROI C113%. RSI at 53.9. Healthy, not stretched. Prism says, accumulate. This is the cleanest setup in the group right now. Strong business, fair price, good technical structure. Arista, high quality business with strong efficiency and momentum scores. Real AI infrastructure exposure. But smart money turned bearish today, and RSI is at 78.5. I'd want to see the stock pull back before getting more interested. Salesforce, 41.8% below fair value. $14.4 billion in free cash flow. Business is not broken. But today's 9.68% jump pushed. RSI 72.6 and Prism dropped to plus 12. The fundamental gap is real, but patience is needed for the right entry. ServiceNow, 37.3% below fair value. Revenue growing 20.9%. Durability 8.0. The sell-off was an overreaction. But RSI at 82.6 right after a 9% day means timing is tricky. The opportunity is real. The entry timing is what needs watching. Look, I want to be clear. None of this is financial advice. I built Invyra, and this is how I read the data. What you do with it is your decision. But I believe this. Better decisions come from better data. Not from price charts alone, not from headlines, not from what's trending on social media. That's why I built this, and that's why I show you exactly what it finds. If you want to run this on any stock in your own watch list, Invyra is free right now. No credit card, no commitment, just go try it. Link is in the description.